Ruchir Sharma, Morgan Stanley Investment Management, penning an op-ed in the New York Times entitled Trump's Dangerous Obsession with the Markets, in which he highlights how the president has been making critical decisions based on stock market moves. Ruchir Sharma joins us now to talk more about it. Why is that so dangerous, Ruchir?
Well, I think this is firstly unprecedented territory, as we know that we are historically conditioned to thinking about what will be the reaction of the stock market to some sort of political or economic news. But when you're actually making policy with the objective that we have to keep the market going, I think that sort of becomes a bit dangerous. But this is a broader phenomenon where the tail now has begun to wag the dog. This is very important because the size of the global financial markets today is 3.5 times larger than the global economy. So I think we have to just completely change the way we are thinking here about the market. It is no longer the fact that the market just reflects what's happening in the economy, but the fact that the market drives what's happening in the economy and possibly as far as policies are concerned as well.
But Ruchir, could you not argue that so far, at least in his term as president, it's worked? The economy's been strong and the market's been strong. You couldn't, for example, say the same to the same extent with the last administration, where the economy wasn't as strong, but the market was.
Well, yes, but so this is not a criticism of the policies as far as the current administration is concerned, but just an awareness that this is what's going on. And the most remarkable turnaround, I thought, was on the trade front, that the fact that this is one position on which the president had been very consistent going back to the 1980s, but we began to see a remarkable turnaround on the trade front sometime in late October, early November, when I think it became apparent to him that this was sort of leading to a market decline. Now, of course, you could take the positive view that maybe this is a good thing, that it's sort of preventing the excesses from happening. But as you well know, the market is driven by many factors. And just to start basing policy decisions on what's going on in the market, I think could lead to the wrong conclusions.
Well, I mean, is the ultimate conclusion for investors here to just buy this market as long as Trump is in power, because there's a put, essentially? He's not going to let it go down?
Yeah, to the extent you believe that he can control the market, yeah, I think that is what the sort of implication is. But as you know, with these puts, the danger is this, that once it breaks, then the downside becomes much larger, because then the sort of floor comes out in a way, because that sort of confidence is gone. So yeah, this has become a much more momentum-driven market because of these factors. First, we began speaking about the Greenspan put back in the 1990s. Now I guess we can speak about the Trump put, which is that the incentive is to keep the market going higher. What the fallout of that is, the fact that if it ever reverses, then obviously the downside is obviously much greater.
Ruchir, whilst we've got you, always good to ask you, on a 12-month view, what's the top country pick at the moment in your eyes?
Well, I think that some of these emerging markets that we have spoken about, the big sort of story in the world today is this, the fact that the US economy is 25% of the global economy and yet 55% of the global market cap. Emerging markets, many of these countries, for example, in Eastern Europe, Southeast Asia, Indonesia, Poland, these countries are a fraction of the global market cap. So I would say some of those countries is where I'd be looking to allocate money and away from the US over the next 12 months.